Ladies and gentlemen, please welcome Jeff Gitterman. Jeff, come on up.
Fascinating to have a climate adaptation conversation when it's 105 degrees in New York City. Timing is everything. Last time I did a presentation here, none of my panelists could come because of the fires that were happening in Canada. Every flight in was delayed. So I was talking to a video monitor as the moderator, which was fascinating. Unfortunately, lost one person on our panel this morning. TAPIWA SIKIPA is unable to make it, but I am joined by two incredible women, Emily Chu and CATE AMBROSE. I will let them do short introductions. I'll do a quick introduction. My name is Jeff Gitterman. I've been in the climate space probably for the last 10 years or so. I hosted the United Nations Sustainable Development Goals conferences and then Climate Week at the Nest Summit and the New York Stock Exchange. And I hosted a TV show on the floor of the New York Stock Exchange called The Impact. And I have an asset and wealth management firm. We manage about $1.5 billion. And our focus has been for the last 10 years or so, climate adaptation, which is why it was great when I found out that Emily was going to be on my panel, because last month I was graced by having GIC, Temasek, JP Morgan, Jefferies, and Man Group all publish climate adaptation papers. I published one in 2019. It was lovely to see some company. I think they say if you want to find good investments, you can't be the only one selling them. There has to be other people involved in the trend as well. So it's really great to see that happening. Emily, why don't you do a quick introduction and then CATE.
Sure. Hi, everyone. I'm Emily Chu and head of sustainability at GIC based in Singapore. But most recently, before taking up this role a year ago, I was actually based in New York. So it's great to be back. And coming from Singapore, I kind of don't mind the heat, actually, as long as we can enjoy several hours of air conditioning every day, as we get to do in this beautiful space. At GIC, sustainable investing is one of our top 5 enterprise priorities. And in executing on that, we have established 3 years ago a central sustainability office, which I lead. We'll soon be around 16 people, and our role is to accelerate the adoption of sustainable investing across all of the asset departments at GIC. That involves both assisting the asset departments to identify and pursue thematic allocations to sustainable investing with a very strong focus on climate in particular. That's where most of the capital formation that we see is in the sustainability space is happening right now. We can execute on it right now. And then the other key part of sustainable investing is sustainability analysis. We call it pervasive integration of sustainability factors into investment decision making is like a hygiene factor across everything that we do. So we're on this journey as many other firms are, and in terms of as a very long-term investor that's very global, we see that these themes and this investment discipline as very aligned with our mandate to preserve and grow the reserves of Singapore.
Wonderful. CATE.
Hello, I'm CATE AMBROSE. I run the Global Private Capital Association, which is an independent nonprofit membership organization of fund and institutional investors, usually investing outside the U.S. It was originally founded by the IFC of the World Bank as the Emerging Markets Private Equity Association. I joined in 2019 to reposition the organization for the future. Our global headquarters is in New York. We have an office in Singapore with 4 staff on the ground, co-funded by the Monetary Authority of Singapore, dedicated platform for Latin America. Usually the shorthand way to prove my legitimacy is to say who's on our board of directors. Bill Ford of General Atlantic is on our board of directors, the CIO of Temasek, Future Fund from Australia, CPB has been on our board, Cambridge Associates, Andrea Auerbach, and then the leading GPs across the geographies, KKR, head of Asia. As a membership organization, we're trying to sort of bridge and create alignment between asset managers and asset owners. We are primarily asset managers, it makes up the bulk of our membership. But GIC is a good example, or Temasek, or some of the Canadians of firms that have, or institutions that have created direct platforms as well and established offices and are investing alongside or have big direct platforms. Energy transition and climate is a massive part of our portfolio and what we focus on. Again, we were founded by the IFC. We have a big footprint with the development finance institution community, all of the European DFIs, in our American Development Bank, Asian Development Bank, African Development Bank. And we're just launching an Energy Transition Council, which includes the likes of Brookfield, Actis, some of the biggest asset managers, GIC, and CalPERS as well, that are looking at energy transition and actively investing on the ground. And it is private markets specifically. So private equity, venture capital, but infrastructure has become a much bigger part of the pie. Private credit, obviously, but really energy transition and climate is one of the biggest areas to put money to work. And so that's where we're seeing a lot of activity.
So what is climate adaptation? I think it's a big bucket. So a lot of people have different taxonomies around climate adaptation and look at it differently. As a firm, 10 years ago, we started interviewing climate scientists around the globe. And from interviewing climate scientists, what we kept getting told is, go talk to my friend who now works for Swiss Re or Zurich or one of the insurance companies. So the next thing we did is we went around Europe talking to global reinsurance companies. How many people here have talked to global reinsurance companies about climate risk? If you want to get sobered up, this was 10 years ago. Everything we heard 10 years ago was we don't see a pathway to profitability around claims paying on weather-related disasters 10 years ago. The paper we wrote in 2019 was that we would see reinsurance companies backing away from risk. We would see state insurance companies get squeezed by the states because they couldn't reprice the risk, so they would start exiting states. Then we would see municipal bond risk, real estate risk, and mortgage risk at some point go off a cliff. Because as we all know, the markets move really slowly and all at once. If you want to look for that Jenga stick that might be the thing that pulls down the markets, it's probably FEMA and what will happen if FEMA backs off from their current support in post-disasters. Right now, they pay about 75% in municipal and state post-disaster recovery. They're already talking a few weeks back, almost 2 months back, about going to only 50% coverage, which means 100% increase for municipalities and states that don't have the money already. And Trump has already said, not to get political, but he's already said post-hurricane season, he's looking at scrapping FEMA completely. That will destroy municipal credit ratings in many areas. And if you want to see if I'm correct, go talk to the municipal rating agencies who are already discussing rating adjustments because they're already tracking climate risk. Called VAR, Moody's is tracking it, all the different companies are tracking it, they're just not including it in their credit risk. So an A-rated bond can be A-rated but have a really, really poor climate risk rating at Moody's, but it has no impact on the credit rating currently. They're talking out loud publicly now about having those ratings impact them. So that's all I'm going to talk today. First question to Emily, when you think about climate adaptation, and I know the paper that you put out is fantastic, talk a little bit about the taxonomy and what got you there.
Sure, but I also feel compelled to address the risks that you've just highlighted because when we think about climate adaptation, it's the other half of, as at GIC, we've been developing quite a lot of institutional awareness and visibility and kind of focus on climate transition and decarbonization. And climate adaptation is the other perspective, where a failed transition or a transition that isn't happening as quickly as a net zero scenario would suggest it needs to happen. The adaptation, we call it the inevitable investment opportunity. So it's the other half of that. It's also adaptation is both a risk and an opportunity. And I think what you've highlighted is the risks to assets and to financial models and assumptions that we have today around how portfolios are structured that's not climate adjusted. And so we do spend a lot of time looking at physical risk data and integrating a more risk-adjusted approach to the pricing of assets, but also to an assessment of how well protected or how robust the mitigation strategies are of a particular asset, particularly in the real assets and private market space, because of these physical changes that we see. But to speak a little bit about our research, we, as Jeff mentioned, we started to get quite focused on climate adaptation over a year ago now, and started to look at, well, how do we, as a large institution, very long term, invested globally across all asset classes, how do we start to think about this concept, this investment theme? And it really sprang from our climate scenarios work. So we, several years ago, spent quite a bit of time developing in-house climate scenarios as a risk tool to understand appropriate asset allocation. And again, also what was the opportunity set from decarbonization of the real economy that would potentially be available to GIC, and to make sure that our different asset classes were right-sized in their allocation to decarbonization investing. So we had developed these climate scenarios, and they're based on the scenarios from the NGFS, the Central Bank Alliance, that has done a lot of work to socialize this concept on the central bank side. And it's just really kind of robust. It's robust kind of risk management to look ahead at the very long term and to look at, well, if the decarbonization pathway really was to follow a Paris-aligned agreement, a prescribed scenario, you'd see extremely rapid decarbonization of the economy, extremely rapid deployment of technology, you'd see carbon pricing, et cetera. What would that do? And how would we potentially experience that as a shock? And then you'd have, on the other extreme, a scenario, a failed transition. So above 3 degrees on average temperature rise by 2100, the failure to reach net zero by 2050, and then all of the physical risk and disruption that would cause would also be quite devastating for traditional investors, for traditional asset management, and for the models that we use in traditional asset management firms. And essentially, and then we have two, scenarios in the middle. One is a delayed disorderly disruption, delayed disorderly transitions. So you're still transitioning, but you're doing it late. It's disorderly, it's not coordinated across governments. It is also experienced as a shock, but it's still very strong policy action. And then the other scenario in the middle of all of this is too little, too late. So not completely failed, but not enough to really avoid some of the worst consequences of tipping points and physical risk happening. So you've got essentially this span of scenarios. And where we got to, really over a year ago, was net zero is not the most likely scenario, unfortunately, based on all the work we're doing, looking at climate policy, looking at the actual carbon emissions performance of countries and companies and industries, looking at the enabling environment, looking at the pricing of technologies. So if net zero is not the most likely scenario, there is physical risk baked into the system, and that's an inevitability. And if that and so the question really is, well, how much physical risk is baked in? And if physical risk is baked in, then how do we as an asset management firm need to start adapting to that? And how specifically is the private sector going to start adapting to that? So we got really interested to, we looked at the research into this. There's trillions of dollars needed to adapt. But a lot of those figures are really addressing essentially governments. They're really addressing, and I think the perception that we were finding was that, well, adaptation is a government responsibility. If climate transition fails, governments are just going to have to, taxpayers will have to stump up a lot of money to build seawalls and to do geological engineering, et cetera. And we thought to ourselves, well, yes, governments may be the ultimate customer, the ultimate client, but there's going to need to be a whole rearrangement of supply chain and private business models to serve that end client. So how do you go about defining it? So we started off with the Climate Bonds Resilience Taxonomy. This is a draft taxonomy that's been put out by the Climate Bonds Initiative, a nonprofit organization operating in our space that's done a lot of work to really build more fluency, and to really build the market around labeled and green thematic and sustainable bonds. They, in recent times, have come out with a climate bond resilience taxonomy, also trying to tackle this concept of adaptation. 1,400 solutions on that taxonomy. And we said, well, let's, coming at it from a private sector, a private return seeking oriented investor perspective, how do we narrow this down to something that's actually meaningful and something we can actually prosecute in portfolios? So we went through a process, and it's in our paper, of essentially whittling down the 1,400 to 600 shortlisted. It's still not a very short list, it's still a long list, but shortlisted 600 where they were actually addressing the most material or the most value at risk hazards. So those hazards were storms, floods, wildfires, droughts, heat stress, and water stress. And so 600 of those solutions were addressing those hazards. And then from there, we narrowed down to around 50 that we felt were tangible today, that we could recognize solutions in the near future that were potentially addressable by a private sector business model. Some adaptation solutions are things like move the community away from the shoreline. There's not really a private sector business model there, unless you're talking about relocation services. But there's a ton of other, existing solutions today around windproofing and construction materials and industrial processes, fire retardants, water purification, which are adaptation solutions. And the reason why this is important is because it allows us to then look across our portfolios at what are our existing exposures to adaptation, and then how can we amplify that where necessary.
Thank you. So Kate, maybe we could start by talking a little bit about the impact of public policy and the political environment on commercial investment in adaptation and transition.
Yeah, I think, that one I would address even from a broader perspective in terms of the backlash we've seen in the U.S. On energy transition.
Sure.
And more broadly just out of the adaptation. And it's really just to put the message out that the private sector is well ahead of where the public sector is at in this. I've noticed that continually. I was at COP in 2023, and you just see the massive commercial opportunity that there is to transition our economy, the global economy, into a more sustainable and both energy transition, but across agribusiness, across, of course, adaptation as well, although it's a smaller, there's less of a fund product opportunity there immediately now. But the reality is there are trillions of dollars of assets under management by the likes of the private capital universe. I mean, Blackstone's got over $1 trillion, KKR is right up there, Brookfield. And this is a singular opportunity to put hundreds of billions of dollars to work in investable projects where there is a clear value creation opportunity in the future. I remember having this conversation with somebody at CPB, 5 years ago. I'm not going to invest in anything today with a 10-year horizon that I don't know is going to be sustainable or is going to have a climate risk element to it, because I won't be able to exit that company. Who's going to be the buyer of an asset that's not sustainable, 10 years from now? So we have not seen any pullback at all in the money that's being invested globally. I can't speak to the U.S., but in regions like Asia and other markets. There's a lot happening in the Middle East. Actually, you wouldn't think this is so obvious, but having spent a lot of time in the GCC over the last 2-3 years, it's not just lip service. Masdar is a huge renewable energy platform coming out of the UAE, and they're looking to crowd in other investors. And they've created Altera out of Lunate, ADQ, one of the big sovereign funds, which is putting $30 billion out there to TPG, to Brookfield, to investors globally. So it's really just to communicate. It's not that my observation in the U.S. is that the language is changing. Green hushing was the term that was shared, but not a pullback in terms of the desire and the demand to put those hundreds of billions of ultimately trillions of dollars to work in private markets. I guess infrastructure being the most, and energy transition being the biggest opportunity now, but happy to talk to adaptation more specifically as well.
Yeah, I'll just give you another 2 minutes on adaptation specifically and what you're seeing in private markets.
So there's not, in private markets, it's about a fund having a fund product, right? And we've seen a lot of different types of funds marketed as climate. There is absolutely an element of fund products being created to respond to LP demand or what's perceived to be LP demand. And you have to look under the hood very carefully of what's inside those portfolios because it's a very broad bucket. In terms of adaptation, I'm just familiar with one in particular right now, which is something under Schroders, Blue Orchard out of Switzerland, active member firm of ours and they're focused on climate risk insurance. But it's much more an integrated it's a perfect complement to what Emily has described, sort of a top-down taxonomy, is what is the on-the-ground, bottom-up deal opportunity that we're seeing in markets. And if you just think about, drought-resistant seeds, there's so many different investable opportunities at the company level. And then you have to think about who's going to create fund products that are going to be targeting that specifically. I'd say another more integrated way of thinking about this, particularly in the geographies that we cover as an organization, is the risk is real every day. If you're in Southeast Asia and you're investing in a manufacturing plant or all the data centers, as was cited, that are getting built, you are thinking about adaptation risk or the need to address adaptation as an integral part of your investment strategy. It's just a piece of the playbook, and that is an opportunity. So, where are you locating a manufacturing plant? What is the fire risk? What is the drought risk? And those are all pieces that are being integrated into the investment strategy of private managers in these markets. India, there's a need, again, as you're doing deals and you're investing, whether it's building infrastructure, to think, because this is private markets, not public markets, in a 10, 20, 30-year horizon into the future, and build that into the portfolio companies, the infrastructure projects you're investing in. And that is value creation in and of itself. The one observation listening to the opening remarks, which were fascinating, I'll make the comment, trillions of dollars in the US. We do have these incredibly deep capital markets in the US, and we have the dollar as the reserve currency, conversations I have all the time around the world. But there's also a lot of money out there. And private capital is so concentrated in the US. It's much easier to focus on other parts of the world and see where you can leapfrog and build new infrastructure and, incorporate climate adaptation rather than adapting existing infrastructure assets, building new capacity that has climate adaptation built in an integrated way.
It's interesting. 2 years ago, we did a project where we did a Venn diagram around data centers and climate risk. And if you want to do an interesting exercise to find investment themes that have a long-term trend to them, there's a huge overlap between what data center demand will do around water and energy usage and what climate change is doing around water and energy usage. And then we were able to find an overlap of where investment themes like grid infrastructure and nuclear and other things would probably outperform, because the two biggest trends in the business market today that we see from a risk and opportunity standpoint are climate change and data center build out and demand. I wanted to turn that into your question about what is different about climate adaptation themes from the more traditional types of thematic investing that we've seen.
Yeah, great question. So what we find with climate change as an investment theme, whether you're on the climate transition decarbonization side of the theme or the adaptation side of the theme, is that climate science has been quite difficult to model. Whether you're looking at macro assumptions, I completely agree with Elizabeth's comment earlier that the macro is so important still at the deal level. From the bottom up, you can't forget about macro factors, and we very much position our climate research as a critical part of macro assumptions that we need to integrate. It's just difficult there hasn't been kind of discipline around how do you build the connectivity between climate change and macro factors like growth and interest rates and inflation. And there hasn't been taxonomies that allow us to prosecute on these themes very easily. So you have to do, most thematic investing is around, okay, it's around a particular sector, like a healthcare fund or a technology fund, or maybe it's kind of emerging markets, or it's regional, or it's frontier markets, or something like that. And then, frankly, the sustainable investing space, when you're looking across industries, you don't have an existing, taxonomy that you can receive from, say, like a GICS classification, for example, that enables you to easily understand how can I access this theme. So you start to look at things like, well, revenues, revenue mapping of companies to particular themes, but then you have to actually understand, how do we get that information? So one of the things that we did in trying to understand, as we went through and we got to these 50 solutions, and then we worked quite intensively with our consultant partner Bain on this work, and also our investment departments, consulting them on, of these 50 solutions, what are the most attractive ones. We settled on 14 categories of 21 solutions. And then we went about defining a total addressable market today and growth assumptions into the future for these 21 different solutions, in order to come up with the conclusion, the punchline of our paper, which I realized I buried earlier. The punchline is that today we see from these 21 solutions about 1 trillion of annual revenues that we expect to grow to about 4 trillion by 2050. According to our base case, which I can get into, and we estimate that of that, around 2 trillion will be incremental revenue growth driven by global warming. So the climate change kind of elasticity of demand factor that we applied is around half of that growth, and then the corresponding investment opportunity set is around 2 trillion today, growing to 9 trillion by 2050. So the point is, it's a meaningful number. Now, how do we get to that? Well, it's actually quite challenging, because how do we kind of find the right growth factors looking at historical data when you can't kind of go to a GICS taxonomy and kind of click on your climate adaptation group to look at the past 10 years of growth? Well, we actually used a large language model and kind of AI technologies to filter through thousands of companies to identify companies that were providing solutions in water purification, in building materials, in cooling solutions, et cetera, because it wasn't necessarily just reported clearly in their financial statements, going into their their other disclosures to identify, where do we find companies that have a meaningful exposure to this, coming up with thematic baskets, and then from that, looking at the last 10 years of their kind of mid-cycle equity and debt valuations, their enterprise value, in order to come up with essentially a growth factor that you could expand out into the future. So those are the types of things you need to be able to do to understand what's the investable opportunity in this space.
It's interesting too, because I think it gets so broad if you want it to be broad, because you just look at what's happening even across the Midwest during the current heat waves, with roads buckling and airplanes not being able to take off because the runways were too hot and the tires were melting. I mean, all of this is the fact that we've built our economy and our infrastructure on 12,000 years of a stable climate that is now not as stable anymore. But all our building codes, all of our legal language around building codes, all of our infrastructure has been built for a certain temperature band. And, I talk to a lot of people all the time that don't think climate change is an issue. And they always say, I get up, yesterday was 20 degrees cooler, and today it's 20 degrees warmer, and I'm fine. And I try to reference them to think about ice cream, because ice cream is one of those things that is fine until that 1 degree moment where it's not fine. Instead of thinking about the human response, think about what our roads, our bridges, our tunnels, even our agriculture, certain crops that grew in Georgia, they're not having peaches anymore because it's too warm. So we're losing peach crops in Georgia. These changes and shifts all lead to adaptation solutions. And look, I hate to talk about it that way because for 10 years, adaptation was talked about as a cop-out. That if you were talking about adaptation, it's because you weren't doing enough on mitigation. But the reality is that we have to do adaptation and we have to do both. So adaptation isn't instead of mitigation. Adaptation is, while we get our shit together on mitigation, we better be adapting so we can survive the moment. Now, we've been talking a lot about US CAPE, but maybe you can talk, and I just gave some examples of US needs of adaptation, but maybe you could talk a little bit about globally in Asia and Africa. What are the needs that you're seeing around adaptation and what's driving demand there?
Yeah, I sort of touched on this from a high level in the last comments, but there is an opportunity to build new infrastructure and to build things in such a way that you're taking into account. So I really observed that leapfrogging. I mean, in Southeast Asia, in Malaysia, as you know well, in Indonesia, there are, there's fire, there's flooding, there are inherent risks, and we do see that no deals are being done. I mean, if you take a broader look at the taxonomy and you look at areas like software technology and software that's going to measure the risk in farming, the great incorporation of artificial intelligence on some of these cases, and some of the greatest innovations you see from places in the world where there's just a need to address these risks. I think Europe in many ways is at the forefront as well, not necessarily in some of the innovation pieces, but at least in the commitment and their willingness to think about these issues. And then in Africa, again, obviously very high risk of drought and so many of the climate crises that they're dealing with in that part of the world. And a lot of new energy infrastructure is being built and incorporated in that. I mean, again, I'm using a slightly broader taxonomy here, but the off-grid, the closer the grids that are being built that are closer to the actual consumption, where things like data centers, et cetera, are being set up, is just a response. Sorry, it's building from the bottom up, and then, as I mentioned, in the Middle East, an enormous amount of construction going on in Saudi. It's remarkable how much money, the GCC has become this kind of center of the investment world. All of the big, not only the private capital managers, but hedge funds and others setting up offices in that part of the world. And that's contingent on money being put into those markets. Saudi is building an enormous amount. And I've raised the question of how much are they thinking about, adaptation. It's not completely clear to me, to be honest. There's, I think, a high level commitment, but that bottom up understanding, and I've seen both GIC and Temasek making trips to the Middle East as well and asking this big question: what role would the GCC play with the enormous influence they have and the, trillions of dollars they're putting out into adaptation and not just all of the construction that's going on in that part of the world.
I'd love to open up to some questions that way.
Should I go first? Thank you all. I have to say the GIC adaptation paper is one of the more concrete papers on this topic I've read out there, so I appreciate that. I think as I was reading that paper, and as we think about investment integration, potential product launches, one key question that keeps coming up, and I'm curious how you all think about it, is this new theme kind of a separate pillar as a vertical, or is it a horizontal theme you kind of think about integrating into your existing, mitigation related investment? And one thing I do want to highlight is in this political environment, like the risk from an asset manager perspective, launching new product is criticism of greenwashing, right? Like I can, out of the GIC taxonomy, I think one of the themes being highlighted at the kind of the end, scatter plot you guys had was cooling. Yeah. But, if we included cooling in a specific adaptation fund, I'm sure we're going to get lots of criticism, right? People are going to say, you guys can't sell climate funds anymore. Are you just going to add, new labels so you can market it, in a different way, right? So I think that's why, do you treat this as kind of a dedicated pillar and you really argue there are pure play adaptation investments? Or do you say we're integrating it across our existing theme is a real question?
Yeah, great. We're still thinking about that. I don't know that I have the full answer for you, but the starting point was really just trying to get our hands around how big is the actual potential opportunity. How would you go about kind of even identifying what an adaptation play is? I'd highlight a couple of things. One is that whether there is enough justification for a dedicated fund product that you allocate to does somewhat depend on, the role that it plays in different asset classes. If we look at our decarbonization investments, for example, one of the things that we've done, one of the things I would say is that we did similar opportunity sizing work for the decarbonization space a couple of years ago, and slightly different data set in our scenarios. We use the IEA scenarios there because the IEA has done a lot of work to really scale down the amount of investment the amount of growth, across the different decarbonization technologies, which we can then translate into revenue sizing and enterprise growth. But in any case, our decarbonization work suggested there was a $5 to $11 trillion investment opportunity by 2030. Again, depending on the scenario, we're going to be updating that work because the scenarios have shifted, given the not just the political environment, but everything that's happening geopolitically as well. And so if you think about $5 to $11 trillion by 2030 versus what was my number earlier? Up to $9 trillion by 2050. You want to kind of make sure that your allocations are right-sized according to the size of the investment opportunity. And then on our decarbonization side, we set up specific sleeves within public equities, fixed income, and private equity to prosecute the climate transition and decarbonization theme. We did not do that in real estate and infrastructure. Rather, in real estate and infrastructure, the decarbonization theme is really more integrated across everything that we do. We didn't set up like a separate pot of money just for kind of green data centers and for renewable energy assets, although our infrastructure team is pursuing those investments where it makes sense in different geographies. So I think there's different considerations around asset allocation, and we haven't yet decided that it's appropriate to allocate specific allocation just to adaptation. The other thing I would say, but although what it has done for us is just sensitize all of the investment teams to the lens. And so both from a risk management perspective as well as an opportunity capture perspective, they're now looking at it across these different solutions providers, particularly in industrials. And on the real asset side, they're looking at it as a mitigation from mitigating the physical risk, and then what are the products that they would need to be able to buy in the supply chain in order to do that, or what's the right amount of insurance. The other thing I would say is that when we were speaking to asset managers about this, we were finding that under the label of a climate portfolio, you can have adaptation plays as well as the transition plays, and that might be the most appropriate way to provide almost like the right amount of flexibility in your own climate thematic allocation. You want to have almost sub-allocation buckets. And we were speaking to an asset manager that had a climate adaptation fund, but actually a large portion of it was actually transition plays. The final thing I would say is that many of the solutions actually can play both ways. So cooling can be both energy efficient, it can be a climate transition play, but it can also be an adaptation play in a world where you're expecting warmer buildings.
I just want to add one sentence. We look at it in our portfolios, the risk horizontally and the opportunities vertically.
And then it's just a reflection of, again, the products that are out there, and Emily spoke to that, very well. I think what's important is that you see the institutional investor demand and response, because fund managers raise funds, in response to the LP demand for those products that they see out there. And I would probably have the sense that certainly today it's more of a horizontal, opportunity, because there's even in public markets, I guess there may be some products, but it's not a huge space, but it certainly is an enormous opportunity, going forward. And if we see the LP demand for whether it's within a particular fund product or, as Emily was describing, something that's a little bit more, integrated, and you see with alongside transition, et cetera, that's going to drive more product creation.
Yes, sir.
Hi, it's Greg Van Enwigen from Vanco Global Advisors. There's a question for Emily. I have to confess, I have not read your paper yet, but it sounds fascinating and like a great contribution. I did have a question about the this growth factor that you've developed, and I know you're trying to get away from GIC sectors to something more relevant. But just curious, working backwards, once you got your growth factor, did it actually map into certain sectors that concentrate in certain sectors? If you kind of do a principal components analysis working backwards, what did that look like? Thanks.
What we found was that the climate adaptation theme was it was diffuse across a number of sectors, with some emphasis, I would say, on industrial solutions, building materials, construction materials, but then, some kind of infrastructure, but then also, interestingly, weather intelligence. Like technology. We actually found that, technology, there could be a technology play in the adaptation theme. Then obviously insurance, we identified also as an important growth opportunity as well. So you can find these adaptation plays in a number of different sectors where you could maybe in theory construct something that was diversified across traditional sector buckets.
Yes, I will be very concise. I also first agree with Elizabeth's comment on the macro trends we cannot miss as semantics. My question is, due to AI's rapid development over the past, I want to say only a couple of years, so to speak, I could not imagine that all the data centers have been built out to incorporate the climate risk, which is existential, I think. So do you have some good examples of who have done that, especially among the GPs, because they participate heavily in terms of the capital sector? Thank you.
I think those who are building data centers have no choice but to think about this. And a lot of but I think it's less of an adaptation topic. I think if it's more of an energy supply topic, and that is driving, additional creation of renewable energy, because it's just easier to locate and create a reliable source of energy closer to the data centers. But, I would call that more of a transition than a adaptation. I don't know.
Yeah. It's I know that in places like Singapore and Brazil, there's actually quite some experimentation going on with tropical data centers, and the very specific way you need to build a data center so that it can actually operate in a very hot, humid environment. So there's like a test bed in Singapore, for example, that's looking at different optimization of the air conditioning, fans, and water cooling, and different types of chip cooling technologies. I'm sorry?
In fact, mitigate the environment.
Well, it depends on whether you're approaching it from, say, a data center resilience in a world where you've got more physical risk and you've got hotter conditions. One of the biggest risks to industry and to business from the physical risk side of climate change is just heat stress, like hotter conditions that actually, like, for example, in a heat wave like this, certain equipment you just can't operate. And data centers is one of those critical pieces of infrastructure that would be more difficult to operate. So the cooling system is really important. And in different types of climates, the cooling system needs to be adapted and different. We have also then, frankly, looked at data centers more from a transition perspective. So how do we make sure they get built in a greener way? Really challenging right now when you just don't have enough power. It's really, in some ways, the data center load growth and the load growth from other types of energy use as well is just driving all types of energy to come onto the grid as quickly as possible. And renewables is part of that. So 2/3 of the investment last year in energy growth was in renewable sources globally, China being a big piece of that, but also the US. But because of just the amount of load growth, I think that it's going to be challenging for it all to be renewable in the very near term.
Yeah, Microsoft has done 2 deep drilling geothermal data center projects. You can Google them and read about it. And then I would just point to all of this investment in SMR nuclear technology is because of data center demand, and they're desperately looking for ways to find the power right now. And not having the best luck yet, but I think we have time for one more. Anyone on this side? I feel like I'm ignoring the stepchild of the room.
I got somebody here.
One in the back.
Yeah, thanks. Hi, Matthew Lee from MSCI. I'm curious in the next 5 to 10 years, what asset classes you think will grow the most in terms of adaptation themed investments. It seems like you might have some large public companies, engineering companies where adaptation solutions are a very small part of their business and they don't explicitly report it, versus some of these smaller pure plays and emerging economies that are mostly private economies, and we don't private companies, and we don't really see also project finance that's adaptation explicitly based, right? It's often a little tagline, a little add-on. So it's just very hard to track or conceptualize for me, like how this grows in the next 5 to 10 years. So would love your insight there.
So actually, our equities group has just done a really interesting project looking at CDP disclosures. We're going to have to use AI and large language models to really get at this, because I don't think corporate disclosure is going to evolve fast enough for us to quickly kind of monitor these things in a Bloomberg terminal. But we've just done a big project looking at CDP disclosures across 25,000 different entries, which you can't process as an individual, as a research team, looking at the different kind of trying to understand what's the anticipatory demand in different industries. So which industries are the most proactive in kind of identifying that physical impact is a big issue and that they need to mitigate, and what are they doing to actually mitigate? And the usual suspects like mining and oil and gas kind of came up as the more proactive industries. But then we found that there were other industries, actually like property, that on average, we're not identifying physical risk actually as one of the most material risks, and they were not disclosing what they were doing to adapt. So I'm not sure that I'm really answering your question about how we do this well, but I think that we're going to have to be able to look at what companies are disclosing. And if you look at, say, earnings calls, some of these more alternative data sources, we'll be able to start to identify patterns with the assistance of pattern recognition technologies like AI.
Yes, sir.
Thank you very much. I just wanted to comment. One of the things I really like about this panel is you're not just talking about risks, you're talking about mobilizing capital, which is so important, because if we're going to solve these problems, it's not about, what do I sell? How do I protect my portfolio? What do I do? It's about where do I invest, and taking advantage of opportunities, but also deploying capital into solutions. So thank you. I really like your work on your report and also your comments in the private sector. So thank you. I think we need more of that.
Thank you. And if you guys are interested more in opportunity, Jeffrey's put out an adaptation paper last month as well, which lists about 100 companies on adaptation that they are covering. But there's a lot. GIC's paper is the best, but there are a bunch of others that have just come out. Thanks, everyone.